This is a download from BFM 89.9, the business station.
Good morning, Dodge. So OPEC's decision not to cut output sent oil stocks and producers reeling all over the weekend. Will this be the end of the US shale gas producers, you think? And if that's the case, what could be the economic impact?
Good morning, Nadia. Yes, shale producers will have to rethink their strategy. Obviously, this is much in flux, and it is a strategy that OPEC has not used in the past. But what I'm cognizant of the most within the commodity arena is that commodities are priced on the existing attendant circumstances and act as though they're contingent on these circumstances lasting forever. Right now, consumers will enjoy oil abundance while it lasts, but they should also be planning for a future where producers are again in control. And there are two sides to this equation, the supply of oil and the demand for oil. We looked at it on September 14th and saw that the real problem was the oversupply of oil. Now it is on both sides, and the balance can change rather quickly if the world economy improves and oil producers have to cut back in response to the past. I am very concerned that shale will decide to cut its projects to the point where it will take a long time for them to react to future changes in supply and demand.
As we wrap up 2014, though, talking about the future, do you think the bullish sentiment will carry on into the new year and beyond? Or, as most people are predicting, 2015 will be rocky in the first half as we still worry about interest rates, but calmer actually in the second?
Well, U.S. markets will continue to have a further run through the end of this year, but an increasing number of individual stocks are already not participating in the run up. The S&P 500 is at an new all-time high, and yes, has risen an energetic 24.95% over the past 18 months. Yes, all seems right with the world. But during the same time, the percent of stocks rising to new 52-week highs has dropped from 27.8% to just 7.4% this past Wednesday. So the slow process of forming a major top is underway. So for the rest of this year, I am constructive. For the first quarter, I'll be watching for erosion in Dow Jones Industrials and the Russell 2000, more than the NASDAQ or the S&P 500. But timing will be everything. Can the U.S. continue on its path to economic progress enough so that by the time the market is ready to complete its top, the fundamentals will kick in and support the technical strength that we're seeing now? Remember, there is a difference between a company and the stock of the company. I'm hopeful that the market will be able to transition its valuation from the promise of the future to current economic strength. Where we're going to see the difference is in the second quarter of next year. That is where the tale will be told as to whether we have to go through a pullback of more serious nature or if the economic strength that we're going through right now will come to fruition.
What sectors do you think will actually do better or at least or worse actually next year?
Well, oil is going to be the most major one. We're doing some extensive work now as to decide what the future of oil, particularly oil, not as much shale. The financials we think are going to do quite well. We're already seeing that. And more important than a particular industry at a particular time, Nadia, is going to be the sector rotation, which we definitely will continue to see, just as we have this year.
The Eurozone continues to be a non-event, and inflation for Germany came in at low. Actually, all the inflation for the whole region actually came in quite low, on the low side. Will this prompt more drastic measures? But even if you prompted more drastic measures, what other measures are there left to take?
Well, that's quite a question that the Eurozone is going to have to answer. When you look at the Eurozone versus Great Britain and the U.S., they certainly have more modest goals for next year. Basically, they want to avoid a third recession that they've already had two in the past 7 years. It will face another disappointing year in 2015, but I suspect it will be able to succeed in avoiding a recession, but just barely. Deflation will continue to be a real threat. Consumer prices will rise probably around 1.2, 1.3%. Germany, which is a bulwark, the strong nation, but unfortunately, it is very affected by what's going on to the east in Russia, and it is very much dependent in several ways on what Russia does with regard to energy. Germany is looking pretty fragile with a depressed business sentiment right now, despite its being the strong nation of the Eurozone. So the ECB is trapped between talk about cash infusion, which Draghi continues to use very skillfully, and the German feeling of anti-stimulus strategy. I suspect that they're going to have to go through a QE at least once, probably in the second quarter of next year, and then again revisit it in the fourth quarter.
Black Friday has just passed, and some are reflecting weaker numbers, actually. Is it a bad sign in terms of consumption for the US, or is it because actually Black Friday strategies have changed? It is no longer just one day.
Well, this is a little bit more of a positive response here. U.S. consumer sentiment is definitely at its highest level since 2007, and of course we've been helped by lower petrol prices as well as improving job prospects. An increasingly competitive retail climate that we have over here has resulted in many stores opening earlier on Thanksgiving and launching holiday deals in mid-November rather than one day. Foot traffic was reported by ShopperTrack to have increased 27.3% on Thanksgiving versus a decline of 5.6% on Black Friday. Early figures from IM on online sales show that online sales have increased 14.3% on Thanksgiving and 9.5% on Friday. And sales from mobile devices have jumped over 25% for both days. Also, we still have a long holiday season, and it's really the retail season is now more of a marathon and not a sprint. 7 of our year's 10 biggest shopping days have yet to take place, including Super Saturday, the final Saturday before Christmas, where people like me who wait to the very last minute rush to get their Christmas shopping done. I suspect the retail sentiment right now is quite positive, and I think that ultimately at the end of the quarter we'll see very positive results compared to last year.
Will 2015 continue to be the year for the US, or the focus shift to other markets such as China based on all the current signs?
It will be both. Rarely have the world's big central banks pursued such divergent policies. America's Federal Reserve will raise its main lending rates in 2015 for sure, despite worries in financial markets and fears of a slowdown elsewhere. When U.S. interest rates eventually rise, money will flow back here and away from developing economies that still need it. Periodic but short-lived panics will occur next year as money is pulled out of places like South Africa and Turkey and sent to the U.S. and Great Britain. The gap in investment rates will widen in favor of the U.S., and this will restore more of the U.S. dollar of that luster that was lost over the last 4 years. But that's just from one particular point of view. Asia's giants will struggle for a clear path next year. Japan appears to be winning the battle against deflation overall, although at the price of increasing taxes. Clearly, Abe is committed to start bringing down Japan's mountain of debt. China is using both stimulus and a regulatory squeeze and has not decided what path to use, and probably will use both to get through to the other side. India, on the other hand, seeks an acceleration of their growth, but without inflation. Emerging Asia will remain the fastest growing region in the world, and many more countries will experience more growth than they did in 2014. But the real threat will come from Europe and the global interest rate concerns. U.S. markets will experience a further run through the end of 2014, as we talked. Next year, there will be a fairly big question. We'll have to see. So in terms of where the positive action will be, U.S. will continue its economic strength, but where the real action to be watched is it's in Asia.
That was Dodger Dolan, Chairman and Chief Investment Officer of Landa Infused Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.